Hi everyone, it's Jack back with another video. Today I'm going to be analysing ASML, one of my favourite companies that's been on my watch list for a very long time. It's a $275 billion company that produces lithography machines for semiconductor manufacturers. The market leader in DUV lithography and has an earned monopoly as it's the only company in the world that produces extreme ultraviolet lithography machines, the technology used in the most leading edge chips by Taiwan Semi and Samsung. As of today, I said $275 billion company, down about 24% from its all-time highs, which it hit in September 2021. Significantly reduced price, so at these prices we must ask, is it undervalued at these prices and is it fair value? First thing I like to analyse with a company of this size and growing at the rate it is its balance sheet, its cash, its debt and its profitability metrics. Cash debt ratio of 1.86 is favourable, indicating $1.86 of cash for every dollar of debt. Not the best you will see by any means and not the best for ASML's history. However, the company has excellent cash flows which more than make up for this. Debt to equity and debt to EBITDA are also favourable positions at 0.4 and 0.58 respectively. Strong metrics versus ASML's history. The company also has excellent interest coverage, some of the strongest in the company's history. This combined has seen the company assigned an Altman score of 8.46, a strong score indicating it is not at risk of financial default and the company is far from financial distress. Profitability is where ASML really shines in my opinion. 35% operating margin and 30% net margin is truly outstanding. 30 cents of every dollar of revenue taken home by ASML in profit. Return on equity, again, outstanding. A strong business may have a return on equity of 20%. ASML's at 48%. Very, very strong. Return on assets, not as impressive as return on equity, but still exceptional relative to the wider industry. For a company in this industry at this size, I would expect perhaps 10 to 15%. From a profitability standpoint, this is one of the most impressive large cap companies I've ever analysed, and this combined with the management's strong capital allocation strategy forms the foundation of an excellent prospective investment. Gross margin runs between 50 and 55%, net margin of 30%, return on equity of 48%. I can't stress how strong these are, especially for a company of this size. Next on my checklist is valuation. Of course not as important to the business, but very important for the short to medium returns of the stock is valuation, especially in today's market. From a valuation point of view, the first port of call is of course the PE ratio, PE of 41 and a forward PE of 35. This is significantly above the current S&P average of around 20, so not conventionally cheap. There's certainly some growth assumption here. 20% growth is kind of assumed for ASML going forward, although I think there is some discount to be had here for a company growing at 20% compound annual growth rate, long-term tailwinds and a 30% net margin. This is actually quite cheap in my opinion. Price to free cash flow of 24 demonstrates that the company's excellent cash flows and that there is a current discount here. This is some of the cheapest you'll have seen in ASML's history, near the all-time lows, and in my opinion represents opportunity. PEG ratio of 1.6 is also some of the lowest in recent history, indicates that growth is not yet properly priced in while there is some growth assumption. The next stage in my evaluation is to do a discounted cash flow evaluation to calculate a fair value based on the future cash flow predictions for the business. As I believe that a demand for ASML's products and services will only become more relevant and more needed to the global economy at large, I think 20% growth is achievable in both revenue and free cash flow going forward. Using free cash flow 10-year averages of roughly 22% seems most sensible to me. I've rounded down 20% just for ease. 5 years of 45% doesn't seem achievable going forward just because of the law of compound. These are going to be ridiculous numbers by the end. And 1 year of 180% is obviously not achievable going forward. So I've used 20% in the growth stage. Based off this with an 8% discount rate for the long-term return to the stock market and a 4% terminal growth stage rate, this gives a fair value of $1,185, a significant discount a significant premium over today's stock price of $677 and a 43% margin of safety. Of course, this reflects ASML maintaining its growth rate of 20% for the next 10 years, which some may appear a stretch or at least optimistic. I believe that this is achievable, and I also believe that the margin of safety with this model makes this tolerable. Assuming a 15% free cash flow growth rate even, which I would say is more towards the absolute realistic, perhaps pessimistic end, the company's fair value is still $835. Again, this is a significant premium over today's stock price of $677 and indicates that the stock is trading at a severe discount to fair value in my opinion and in the opinion of my model. On January the 19th, ASML released its full year report, saw some really big bullish indicators from management for the long term that really fueled me towards looking at this stock with a deeper dive, re-emphasising the long-term tailwinds that ASML has, the global megatrends in the electronics industry, increasing lithography intensity are driving demands for their products and services, 24 to 30 billion euros yearly predictions by 2025, with 54 to 56% gross margins. Absolutely excellent outlook in my opinion, from a current revenue base of 18.5 billion euros. They're predicting significant growth beyond 2025, and they're expecting the systems and installed base management could provide an annual revenue growth rate of 11% from 2020 to 2030, based on both the third-party research and their assumptions, so this is fairly well backed. ASML and its supply chain partners are actively adding and improving capacity to meet current and future demand. This is excellent, absolutely what we wanted to see after the reduction in margin this year. And this is really just future-proofing ASML from future supply chain issues, and it's a really bullish indicator in my opinion. All in all, bullish revenue growth indicators, maintaining really strong margins, and this will lead to continued cash return to shareholders and dividends. We sold about just under 10 billion euros this year, more than 3% of the market cap of ASML as it stands. Q4 gave some really strong results for ASML, 5 billion euros in net sales, 54% gross margin, 681 million euros in R&D expenses, and 4.39 euros in earnings per share, and the full year results of 18.6 billion net sales. So you can see there's some acceleration towards the end of the year as they were getting out from under those supply chain issues. Gross margin 52.7%, again some acceleration towards the end of the year. R&D expenses 2.5 billion. Like to see higher R&D expenses so they can maintain that monopoly in the EUV market. The reduction in gross margin is not a surprise, by the way. This is one of the key points in my opinion, that it's slightly reduced for the full year, but the EUV machines have over 1,000 components each. Supply chain crunch is bound to happen. Taking a deeper dive into those revenue numbers, 33% sales growth on really strong demand. Install base business was up 35% again, as I mentioned, 11% compound annual growth rate from 2020 to 2030, really bullish. EUV lithography up to 41%, outpacing DUV lithography, the less advanced technology, which you want to see. Over time, EUV will eventually cannibalize this business, but both providing strong growth even now, and they continue to ramp capacity up. Capital allocation, again, absolutely excellent. 9.9 billion euros returned in dividends and buybacks. That's around 4% of today's market cap. I said 3% before, but the stock price came down recently. Absolutely excellent capital allocation. That is really going to provide sneaky returns over the long term. All in all, what do I think of the company? I've always loved ASML as a business, and I've finally seen a valuation that I'm happy to buy. It's been on my watch list for a really long time, and I think it has never really looked cheap on a PE basis. Of course, a 24% haircut from its highs has presented me with a nice opportunity at a significant discount to my fair value, even with the less optimistic scenario of 15% free cash flow growth. Still $835 fair value to $673 price right now. It's an excellent company that will be significantly larger in the next 10, 20, 30 years. Current market cap of around $275 billion. I can easily see this being a $1 trillion company in the next 10, 20 years, and even larger. Monopolies are so rare outside the world of utilities, and once you get them, you really need to hang on. This company looks harder to disrupt than just about any in the world at the minute. I'll be building this position to one of my largest. I have that much conviction in the long-term strength of this business. So I'm definitely going to be buying ASML at these prices, and I consider this firmly a buy. But of course, you should do your own research, and this is not financial advice. If you're looking for financial advice, you should contact the registered financial advisor. With that, I'd love it if you could like and subscribe the videos. If you're enjoying, thanks.